So here's what nobody's telling you right now. There are 3 economic indicators that have predicted every single recession since the 1970s, and right now all 3 of them are flashing warning signs. Today I'm going to show you what they are, what it could mean for mortgage rates and the housing market, and the possibility of us going into a recession this year. So warning sign number 1, it's called the yield curve inversion. It's the most famous recession predictor. Normally long-term rates are higher than short-term rates. When short-term rates exceed long-term rates, the yield curve inverts. So just to give you an example, the 3-month Treasury is higher than the 10-year Treasury. Another example is the 2-year Treasury is higher than the 10-year Treasury. This has preceded every U.S. recession since the 1970s, and this is happening with us right now. The curve inverted deeply in 2024 and 2025, which historically signals a recession 12 to 24 months later. Mortgage rates are based largely on the 10-year Treasury, so when the yield curve eventually normalizes during a recession, mortgage rates often fall. Just prior to that, we usually see some mortgage rates increasing. Right now, because of what's going on with the war and possible inflation, the European Union's, they've said that they're going to increase rates probably 3 times this year. And as a result, rates are on the rise right now. We've actually gone up we were up 80 basis points earlier today, 80 basis points earlier today on rates. And this trend has been going on since the war began. This is leading us to a much larger possibility of a recession this year. Warning sign number 2, the leading economic index turning negative. The index is published by the Conference Board. It tracks manufactured orders, building permits, consumer expectations, stock prices, and jobless claims. When the index falls for 6 months, recession risks rise dramatically. It's been declining for an extended period, which historically happens before downturns. Building permits are part of the index, and when permits slow, it often signals housing demand is weakening. Additionally, right now, a lot of people don't know this, right now we are in a huge buyer's market because there are about 44% more sellers nationally than buyers. This, buyers, because we don't have as many buyers on the market right now, this is going to continue to cause a decline. It's continuing to cause a decline in pricing, and until that turns around, we're going to continue to see a slowing in the market. Warning sign number 3, tight credit conditions. Recessions are often triggered when borrowing becomes harder. The signs include rising bond yields, bank tightening lending standards, higher credit card delinquencies, and commercial real estate stress. Right now, Treasury yields are volatile, and we are seeing this tightening in the Treasury yields. Mortgage spreads are elevated and more elevated every day with the war. Regional banks remain more cautious as a result. When credit tightens, fewer people qualify for mortgages, which slows housing and the broader economy. And that ties in with what we're seeing with less buyers on the market right now. So here's an important point to take into consideration as well. Recessions are not announced immediately. The U.S. officially determines recessions through the National Bureau of Economic Research, and they often confirm them many months after they begin, anywhere from 3 to 12 months after the recession starts, before they will actually announce that we went into a recession and when we went into the recession. So what does this mean for mortgage rates in the long run? Well, recessions often cause falling inflation, falling Treasury yields, lower mortgage rates, but also tighter lending and job uncertainty. Ironically, recessions often bring lower mortgage rates, but qualifying for a loan can be much harder during a recession. If a recession does arrive later this year, it could actually create opportunities for homebuyers as mortgage rates fall. The key is being prepared before the market shifts. However, another key issue here is what's going on with pricing. So what happens is prior to a recession, which I believe we're in that stage right now, we're prior to a recession. So what happens is prior to a recession, prices are usually down. Once a recession starts and the interest rates drop dramatically, a lot more buyers will come on the market because of the interest rates being low. And as a result of that extra demand, you're going to see prices go up rapidly. So the key right now, in my opinion, is you're better off to purchase when the prices are low and you're prior to the recession. Then you're going to benefit from those price increases and that gained equity. And then you can still refinance later to that lower rate. And you get kind of the best of both worlds. You get that equity boost, and then you also end up with a lower rate because of the refinance later. So that's the key takeaway from this, in my opinion, is why not take advantage of the lower prices? And so many sellers are willing to negotiate not only on price, but also on costs. The majority of the transactions we're doing right now, the sellers are paying most of the closing costs. Once there are a bunch more buyers on the market and we're no longer in a buyer's market, then you're going to see the sellers stop doing that. They're not going to pay closing costs as often. You're not going to get as good a deal on the house. So why not take advantage of what's going on right now in the market? Get a lower price on the house, get the seller to cover your costs, and then once the recession does start, the rates drop, you can refinance that lower rate and get the best of both worlds. So those are my feelings right now as far as what's going on. Do I believe we are going to go into recession? I absolutely believe we are. The percentage has changed over the past few months. We were at about a 20% possibility. Now they're predicting about a 40% possibility. But with what's going on in Europe right now, with what's going on in the war right now in Iran, there are these things that are working against each other. You have higher inflation being caused by that stuff, and then additionally we have a struggling job market right now because we haven't had job gains in the past 10 months, and these things are working against each other. If that continues, then we are absolutely going to go into a recession. One other point to figure, and this is not to get political or anything, but every time we've had a Republican president in office since Ronald Reagan, we have gone into a recession at some point during their presidency every single time. So far, in this current term, we have not gone into a recession. And it is expected by the end of the term, we will go into recession at some point. So if it's not this year, it will probably be next year. But I think what will probably happen is we're going to go into a recession this spring or summer, and they won't announce it until the latter part of the year. We're talking maybe November or December before they actually announce when we went into a recession. And this is going to cause a lot of issues in the market. We are going to see the interest rates be a little bit elevated before the recession is announced. But chances are before the recession is announced, probably 2 or 3 months before it's announced, the economists out there are going to realize we're in a recession, even though they haven't announced it yet. And then we'll see rates start to fall, probably by, I would say, maybe September, October timeframe. We'll probably see the rates start to fall because the economists will know that we're in a recession, even if it hasn't been announced yet. And that's what generally happens. So my recommendation, try to get into a house now if you haven't yet, especially if you're a first-time buyer, because once that recession does happen, you're going to see rates fall. You'll be able to refinance to that lower rate. Once you purchase, you can refinance about 8 months after you purchase. So it's kind of perfect timing. But you're going to see rates fall so that you'll be able to refinance. But the bigger issue here is you're going to have huge equity gains, because once that recession starts, and the rates come down and all those buyers flock to purchase homes because of the lower rates, then you're going to see the prices really go up. A lot of people who are purchasing now will probably gain $40,000 or $50,000 in equity over the next year because of what's going to happen in the economy. So that's my recommendation. If you have any comments or suggestions or questions, certainly let me know. I'm always here to help. Thanks.